If commodities are only just taking a rest on the way to much higher levels, the effects on the economy would be devastating. Is that really true, though? I'm going to cover each and every aspect of this. We're going to look at what they call the commodities supercycle, and I'll give you all of the big banks that are now saying we are in for much higher prices. Let's start here. Trading the commodity supercycle intermission. And this has been something that has been coming up recently because, as we have seen, many prices are way off their peak. Now, that just gives us a little bit of indication as to where we are. When you compare also the US stock market, let's take the S&P 500, and you compare that to where we are with commodities, historically, despite the fact the S&P 500 had come off its high, we are still way off in terms of the ratio in between the stock market and commodities. Commodities are extremely undervalued. Now you look at oil prices, oh my goodness, they're high. You look at all these other commodities and you say, wow, these are extremely high. But still, when you compare that to the stock market, we are looking at that ratio being completely out of whack still today. It's unbelievable, but that's the reality we are in. Our commodity supercycle thesis could be due for an intermission similar to the fourth quarter of 2004 or the second half of 2006 when commodities traded sideways with a lot of volatility. So that happened before. The potential for that to occur again is right here. Since our May report, the quote, demand destruction narrative has driven a sharp commodity price correction. And what are they discussing here? When you see demand destruction, it means higher prices have simply pushed people away from purchasing in that. Now, that happens at the producer level. It also happens at the individual level. When you look at what the consumers are doing, they simply say, I'm just not going to buy that when it gets to this price. There's always going to be a ceiling, and that's going to be showing up directly in their purchasing habits. And you could see this with many different indicators, but generally referred to as consumer sentiment. The BCom index, which is based on futures prices, is down approximately 16% since their June highs, with many individual commodities falling 30 to 40%. The CRB industrial index, which is based on spot prices, is down around 13%. Our supply-demand model for commodities turned down sharply in May and is still weighted down by negative liquidity LEI. So if you want to check it out, you can. I wanted to show you that just to give you a little bit of an idea as to where we are right now and the way that traders are, really assessing all this. But now we look at the banks, okay? Wall Street sees another big commodities rally in 2022. Some of this information is going to be repeated in the next one that I show you here, but you got to understand what's happening, because if once you get that, you really get the big picture, okay? The first half of the year was characterized by supply side constraints that pushed commodity prices up significantly. And you saw that with oil prices hitting $130 a barrel. You are looking at natural gas prices still today going absolutely through the roof. A lot of these things, supply side constraints, are still happening. We are in 2022. We're in the second half of 2022, and we're still talking about supply chain problems that were there over 2 years ago. A growing number of Wall Street banks turning bullish on commodities again. One of those banks that I covered in a recent video, if you are subscribed, you would know that we're talking about the head quant of JP Morgan, Marko Kolanovic, and he said specifically, now's the time to trim a little bit off of your equities and buy some commodities. Okay, and that's the one person who I've never heard say trim any equity at all. Even with oil prices now around $95 a barrel, commodities across the board dropping amid bearish economic prospects, a lineup of analysts see another bull run by the end of the year. Now, what's happening? What's going on? I'm going to show you some facts here that we need to pay attention to. You could look at the data itself. The data is going to tell the story, okay? Don't let my bias put anything on that, or anybody else's for that matter, whether it's JP Morgan or anything. You just got to know the data, and I'll give that. Wall Street analysts are betting on another red hot commodity rally before the end of the year. And you can see UBS has the CMCI, which is the constant maturity commodity index, falling from around 11% from its peak. They expect a 15 to 20% return across commodities over the next 6 to 12 months. Goldman Sachs believes 23% by the end of the year. And these companies here, they don't have to say commodities, they don't have to say equities, they can just say what they believe. And that's what we see right now as prices have been really down significantly in comparison to equities. So equities are kind of, been going up as commodities have been going down. It's interesting, right? You could see here, in general, commodity supply is constrained due to years of underinvestment. Official inventories are low across multiple sectors, and because of weather-related and geopolitical factors. Meanwhile, we see positive demand trends. So what happens here if there is growth? Well, then you're going to need more commodities. That's a fact. But at the same time, if you look at all of this and start to dig in deeper and you believe that there's going to be a massive crash, that there is going to be a depression of sorts, then of course that really changes things. It depends how significant the recession is. That's one fact. But we also have the supply chain problems. And if you're not able to get gas into Europe, let's say, gas prices will go up. Even if demand destruction occurs, even if we have this starting to continue, or I should say continuing, then it's not going to be simply something that can change in an instant. The prices can remain elevated. That's just the way it goes. We have this: irrational expectations are keeping commodity prices unsustainably low. That's according to Goldman Sachs. Now, we can't necessarily believe what they have to say. Look, today commodity markets appear to hold irrational expectations as prices and inventories fall together. Demand beats expectations and supply disappoints. Yet, you could prove incorrect and excess supply does not materialize as we expect. The restocking scramble would exacerbate scarcity, pushing prices substantially higher this autumn, potentially forcing central banks to generate a more protracted contraction to balance commodity markets. Do you see what's happening here? I hope you understand all this. I know it's a little bit technical, but I wanted to cover that before we get into the China factors, okay? Because what we need to understand is that there's always this balancing act. We have the balancing act happening with the central banks and what they do, increasing interest rates, which is going to obviously have an impact on the economy. And then we have the supply side, what is able to come out there. And that's going to be affected as well by weather issues, by what happens with interest rates and borrowing costs, and general demand. Demand from the businesses. Are they needing as much stuff? That's going to be affected by the consumers. You see how this all works together in this cycle. It looks kind of messy and everything, but you start to connect the dots and it all makes sense. I hope so, at least. Clear as mud? Clear as mud. Okay, let's go into the China factors, okay? Because I like to cover China. Why? Because they're the biggest consumer in just about everything. Now, yes, they might be consuming to build empty cities and roads to nowhere and bridges to nowhere, but it's still a consumer. At the same time, they're the biggest consumer of cell phones. They're the biggest consumer of, can you name anything? If you can, they're the biggest consumer of it. China's July economic data showed continued recovery and lingering pressure. Apparently, Q3 growth to rebound strongly. Why? Policy support. Now, this, of course, this is Global Times. They're the big mouthpiece for the country in China. But, you got to see why. Why? Policy support. What do they mean? They mean reducing interest rates. And what else? China seeks to stabilize property market with loans and lower rates. That's right, Chinese banks lowered their benchmark lending rates while authorities stepped up support for the property market with additional loans, an attempt at bolstering waning business and consumer sentiment as the economy struggles. What are they doing here? They're reducing their interest rates while all other countries are bringing them up. At the same time, they are actually trying to push out loans. What does this mean? Well, the banks are going to have to loan out to people and businesses more than they did before. They can do this by reducing the requirements that the banks need to have. How much do you actually need to keep back here? Don't worry, we'll backstop any losses. That's kind of what's happening at this juncture. So I look at it as being a very dangerous policy, but they need to do this in order to get that growth. Now we got one other factor here, Iran's return. So if they, the whole deal goes through, the nuclear deal goes through, and Iranian crude is allowed to enter the markets legitimately, well then you would see Russia, all the factors with Russia maybe not being as much of an issue. Of course it is an issue, because you're now having the Iranian crude coming in. And if you remember, not that long ago, I believe the US administration sent people to Iran, or at least in dealings with Iran and Venezuela, two countries that were, get out of here, you're the worst, you're this, you're evil, you're bad. And then suddenly things turned around. Didn't you see that? Wasn't that interesting? How it just changed in an instant. Now, this is something that will come up in the coming days, so we'll know about that, I believe, in the coming days. So let's pay attention to it. If that crude comes online, which probably wouldn't take very long, we could see prices actually fall in relation to oil. And of course, that could start to affect other things as well, okay? More sanctions on the country, on any country, in fact, is generally not good for the global economy. Depends how big the economy is in general. Now, quickly looking at this. This was something I wanted to include because I believe it's important. Share of electricity production from hydropower. One that doesn't get enough attention. You could look at Canada as an example. It's approximately 60%. So this is the kind of stuff that's just continuing to flow. Okay, they do not have it. And actually what I found interesting here was that a lot of these countries, look at Norway, 91%. So while they might have a particular resource like oil, they can export so much of it. They don't need that domestic consumption because they can use their hydropower. I just thought it was interesting. I will include that in the links in the description. As always, I wanted to finish off with this. Those who have stayed until the end of this video and those who know all of what I talk about, hint, 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 1913, know about central banks. And I want to highlight something right here. Argentina taps former central banker to craft response to the crisis. This is no different than after the financial crisis of 2008, the US government said, listen, bankers, listen, JP Morgan, listen, Goldman Sachs, Morgan Stanley, and all the rest. You were bad. You were terrible. We grilled you here in Congress, and now we're asking for your help. We need you to set up a system that's going to be totally fair and honest and transparent and tough and will be able to withstand another crisis like this. Do you promise to be good? Oh yeah, I certainly believe you do. A central banker is not going to be able to assist with the problems that they created in the first place. The central banks do not work for the people. I hope more people start to realize this, and unfortunately that will not be the case, but I'm bringing it to you because you stayed until the end of the video, and that means you actually want to know the truth. So I thank you for that, and I commend you on your quest to find out the truth. This video was just a piece of that. If you appreciated it, don't forget to subscribe, and I'll bring you all the details related to commodities, the commodities super cycle, and definitely check out the next video because we're going to get into it further. Take care.